now, you find the present value of that, that's 3566. So what now happens to this project in terms of payback? It never pays back. You can never recover, because then after 1 year, you're down 57,265. After 2 years, you're down 23, and there's nothing else to come. So when you factor in the time value of money, you totally reject that project because it never pays back. Whereas if you just use the basic payback, it would suggest that these two projects are equivalent. They both pay back in 2 years. Whereas this one pays you back in a little under 3 years when you factor in the time value of money. So it does have some value, but you still have an arbitrary cutoff period. So, that clear? Pretty good? No? Huh?
Really?
Not really?
No.
Okay, what is not clear? What is true?
I don't know, I'm just lost. Like you're explaining that, I understand the payback period, now you're explaining the discount payback period, I'm not understanding what you're.
Okay, so what's the problem? What's the criticism? What's the criticism of just using the payback? What are the criticisms? Right, so there are these three criticisms of it, right? So, person's trying to fix it, to address it. So you're trying to address this first criticism. Let us use the payback period, but account for the time value of money. Okay? Mr. People say, okay, Robinson, when you lecture, you talk too fast. So I said, so let me come in and try and speak slowly. You try to address the concern. So you're trying to adjust the payback to take into account the time value of money. So this is how we usually do it. Sorry, this is discounted payback. So the first column is your regular normal cash flows, as you would do your regular payback. And based on this, you would say that project long pays back in 2 years. Because you spend 100,000 upfront at time 0. In year 1, you expect to get net amount of 70,000 in, so you are 30,000 short. That's the cumulative column. Everybody with me? And then in the second year, you expect to get another 30,000, so you will really recover the 100,000. So your payback is 2 years. And then these are the cash flows after 2 years. So, now the other project, which is named Project Short, 100,000 up front, 50,000 after 1 year, and 50,000 in the second year. So with your regular payback, after 1 year, 50,000, then you are still 50,000 short. You need 50,000 for it to pay back, to recover the initial investment, right? And in the second year, you get another 50,000, so the project has paid back. Now the point is, one of the points is that based on using the traditional or conventional payback period, you would really say that these two projects are equivalent. They are substitutes for each other. One is as good as the other. Why would I say that based on payback? Why would I say that project long and project short are really equivalent? They are substitutes for each other. You could do one or the other. They both pay back in 2 years. But when you look at the numbers, you can kind of see that these are not equivalent projects. Because after 2 years, project short only shows you love for 2 years. After that, you don't get nothing. Project long gives you some love for another 3 years. So this again, that is where the criticism, not only does it ignore the time value of money, it ignores the cash flows that are generated by the project beyond the cutoff period. Because they're really not equivalent. So what if you then did a discounted payback? So you take these regular cash flows and you find the present value of them using some discount rate, okay? But this looks like a 5% rate. So what's the present value of 70,000 to be received in 1 year's time if the discount rate is 5%? Can anybody calculate that quickly? Are you getting this 59,829? Or is it the 17% there? 70,000 divided by 1.17, what do you get? Huh? Right, so 70,000 divided by 1.17 should give you 59,829? Yeah. Right, so you find the present value of it. 30,000 divided by 1.17 squared should give you 21,915, or if you want to be really mathematically lazy and use your financial calculator. Then you have 30,000 divided by 1.17 cubed. That should give you 18,731. 25,000 divided by 1.17 to the fourth power, and 10,000 divided by 1.17 to the fifth power. Should give you those, should give you that third column. If you use your tables or your calculator, however you choose. Everybody following that? So now you do the payback calculation using the discounted cash flows. So at time 0, you're out 100,000. So the calculators are still going, so nobody listening to me. Go ahead, don't finish the calculation. Huh? Okay, you sure? I don't want you to tell me you lost after. And then I can take it personal. So it's 100,000 down. Present value of that. So now when you add, you're still down 4171. 21,915, you're still down 82. And you get that. So this project is going to break even somewhere in the third year, 2 point something year. Everybody following that? Using the discounted payback. How long does it take you to recover the present value of the expected cash flows using present value cash flows? Is that clearer? Sure? Or you just don't want to work with
No, it's clear.
So project long is gonna pay back somewhere in the third year. What about project short when you apply the same methodology? It never pays back. Present value of 50,000 to be received in 1 year at a 17% rate. So 50,000 divided by 1.17, giving you 42,735. 50,000 divided by 1.17 squared is giving you 35,626. And there's no money coming after. So using the discounted payback does address some of the problems. It's telling you your earlier intuition that these two projects are really non-equivalent. Project long is the better project in terms of the money you're going to make. So you would really reject project short because you're never going to recover the present value of 100,000 from it. Everybody's good? Okay, so this is just a review of of the different techniques that have gone through, definition, the decision rule, advantages, disadvantages. So again, I think in terms of your looking at your exam, it's important to review a table like this because a lot of students coming to an exam like an FN exam where you're practicing problems. But you also gonna have to answer, you're gonna have to write a lot of words. You're not gonna find any question that is just calculation. So being able to write, make some sensible sentences about what are the advantages, disadvantages, and so on, is extremely, extremely important. You know, I have an A for everybody in the class in this bag. I have no problem with everybody getting an A, just come and claim it. But a lot of people miss out their A because they practice the questions and they leave out the explain, discuss, you know, and that's everywhere. Okay, so this provides, pretty much most of this if you can read, if you're interested. People have done a lot of surveys. How do people actually do it in business? How do they make decisions? And this has changed over time. In a long time ago, people use Payback. Virtually nobody does that. In sophisticated companies, people use NPV, IRR, use DCF techniques. So this is a 2002, it's a long time now. I'm showing my age. It used to be a famous study in terms of the popularity, IRR, NPV. So Payback is still in there, and that's an interesting issue. Why do people use Payback despite the fact that if you read any basic textbook, you trash it? Excuse me a second there. Yeah, I'll WhatsApp them, see if they can fit that. And if you want to understand why people still use Payback, then you need to come back and do the master's degree. So the next section of the lecture provides some guidance on how do you actually come up with the numbers. These numbers in here, these cash flows that you're going to use to do the NPV. So it provides some guidance. And it's not so much a set of rules as a set of guidance. So the overarching thing is that what you want are incremental cash flows. Huh? So the numbers that you're going to go in, the numbers that you're going to find NPV and IRR of are really incremental cash flows. So what you want to do is look at your business. Look at 5 Islands. 5 Islands cash flows every year if we do the project, versus 5 Islands cash flows if we don't do the project. So we're really looking at incremental cash flows. Okay, cash flows that change as a result of doing the project. If we don't do the project, these cash flows would not occur. Okay, so again, these cash flows that are going in here, that you're finding NPV or IRR, the critical thing is that these are only incremental cash flows that are relevant. Sorry. So let me just think of maybe a simple example of,
Yeah,
sorry?
that's a good idea.
That's a good idea. So let's say we are doing some analysis as to whether we should do a master's in accounting, right? And our research tells us that for some strange reason, people in Antigua just love accounting, the most boring subject in the world.
Yeah.
And that if we do this, if we offer this, there will be a massive take-up and we will have more students on campus in the evening, right? Now, in costing the program, let's say our security, our contract for security costs us $200,000 a year, right? In assessing the profitability of this new master's in accounting, but this is something I know should happen in accounting, and you guys know. Should some portion of the cost, that $200,000 a year in security, so some portion of that cost be allocated to the masters in accounting and go into our NPV analysis? What do you think? So we have the cost of the program, we have the lecturers, we have the books, we have some light, some water. Should some piece of the security cost go in to coming up with these numbers as we assess that new master's in accounting? Before you answer, what is your theoretical framework? What are you saying? What cost should go in? What do we have on the board there?
Run cash flows with the
Incremental cash flow, right? Increment, cash flows that change. So if our security contract remains at $200,000, whether we apply this, whether we offer this master's or not, should some share of the cost of the security contract be part of the cash flows for analyzing the accounting degree? And the answer is no, because it's not an incremental cash flow. Right now, we are not offering the degree. What is our annual security cost? $200,000. Next year, we offer the degree. Our security cost is $200,000. Should we factor it into the analysis? It's not incremental. It's not an incremental cash. Now, if you're doing cost accounting, as some of you do, you might allocate some of that cost. And that's perfectly sensible and useful for reasons of profit and others, but it is not an incremental cash flow. It doesn't change. Phi Violence cash flows with the degree minus Phi Violence cash flows without the degree. So that's something when you look at the data, like when you have an exercise or a problem, what you're looking for are the incremental cash flows. So there are some concepts here. Some costs and overhead costs are not incremental cash flows. So like the security, that's an example of an overhead. A lot of overhead costs are not really going to change because you do a project or not. Some might, if your light bill goes up, because there's so much people up here in the evening that you have to run it, or if we run the lights anyway, and so on. So overhead costs. Sunk costs, so that's always a troubling concept. Sunk costs, anybody, any idea what's a sunk cost? Any thoughts? Somebody should have taught you this in first year microeconomics. We probably did, but you don't remember.
You know.
You should hear this in management accounting for sure, sunk costs. Any ideas? What do you think? Sunk costs. What do you understand it to be, if anything at all?
Cost or something like.
You know that I'm not troubling you.
Okay.
We- We- want to keep our friendship strong. Any ideas? What do you think? Sunk costs. What do you understand it to be, if anything at all?
No, we tell.
Want to keep our friendship strong. We want to keep our friendship strong. What do you think? Sunk costs. What do you understand it to be, if anything at all? Want to keep our friendship strong.
something like rent, you've already allocated for it and you're not gonna recoup it or something like that.
I don't think rent is a good example, but the language is correct, meaning if you're not gonna recoup it.
Like,
Say that again?
It's not something already occurred or something.
It's already occurred, so economists use the term, let bygones be bygones. You've already made that expenditure. And there's nothing you can do now to recover that money. Whether you go ahead with the project or not, you cannot recover that money. So that cost should not factor into whether you go ahead with the project or not. Not that the cost is important, it's money you've already put out, but you want to think about what is the decision I am making. So let's say Five Islands had an application fee. And when you applied, you paid that fee. So now you're getting so we've sent you an acceptance letter. And you're deciding whether to accept the offer or not, whether to come to do the degree. Why would we say that your application fee non-refundable is a sunk cost and should not factor into the cash flows in deciding whether you're going to accept the offer and come to do the degree or not? Why would we say that? The money dead, whether you accept the curriculum. No, but you've already paid the fee. Whether you decide to come and do the degree or not, you can't get back that money. That was a cost. I mean, that's like the cost of your lottery ticket. So it's sunk. It shouldn't affect your decision financially whether to accept the offer or not. Does that make sense? So think a lot of things like like market research, development costs. You've already spent that money. Whether you launch the product or not, that money is dead. So you can't recover it. So that often tricks people. That's another psychological thing we like to study. Human beings tend to factor in some costs. An example we like to use in economics, behavioral economics, somebody drives to the mall, and you get there and you realize there are no sales. And you figure, I'm here already, so let me buy something. But, the money you spend on gas or the time to get to the mall, you can't recover it. It's sunk, so it shouldn't affect your decision as to whether you buy something or not. So that often trips people up, so you want to look out, so getting these problems, are there any sunk costs here? Any overheads? Account for positive and negative synergistic effects and opportunity costs. Another thing to look out for. So last week we were talking about the example of Antigua Commercial Bank deciding whether to open a new branch, say in English Harbor. Now, if they open the branch in English Harbor, what might be a negative synergistic effect? Right? What might be a negative, and something they have to think about as they run their numbers? So the research might tell you that that branch is going to expect it to generate $5 million in revenue a year. But of that so what we mean by positive and negative synergistic effects is that of that $5 million in revenue a year, some portion of that is going to be people in English Harbor who used to do their banking at another branch in town, who are now not going to be banking at that branch and doing it in English Harbor. So some portion of the revenue in English Harbor is going to represent lost revenue from another branch. Does that make sense?
Yes.
Okay, so these are what we mean by positive and negative synergistic effects. In a way, I guess in marketing people call it cannibalization. So if we launch a new bachelor's degree and we're doing a new revenue projections, you have to think about that, you know, if we launch a degree in economics and finance, some of the people who enroll in that might be people who would have done accounting and finance. So the accounting and finance enrollment might be slightly lower because of that. So, and there can be positive synergistic effects. So if you're KFC and you start offering a vegetarian burger or something, and you are doing your revenue projections, you might have to factor in that healthy people who didn't shop by you before are gonna come. But they might not just buy a burger, they might also buy a drink. So your drink sales might go up because people who didn't previously shop by you look. So when doing your revenue projections, it's not just the demand for the healthy burger, but people might buy something else. You know, while they're there, they might buy a corn on the cob, and then somebody might come in there and they see the healthy burger and they decide not to buy the greasy chicken, so that could be a negative. Okay, so let's take a short break and come back and go through some of these.
So I was just wondering, because I missed like the first half hour, if you can just give me a run through, maybe even after the class or during the day or during the week.
So touch base with me.
Yeah. Like, well, the first half hour. Yeah, I know. I'm sure I get things quickly, so it will.
Takes a little time.
Yeah. Right. Just why is this? Works Minister languages, positions, claims, gender affairs,
Okay. So what am I yapping on about? So basically, in all of these examples and so on, you have been given the numbers. This is the upfront money. This is the money that is going to come into year one. So basically, you've been given these figures. The money up front, the money in each subsequent year. So what we are trying to focus on now, next element in the lecture, how do you come up with these cash flows? They don't just appear out of the sky, they don't just come down. Okay, so the cash flows that are going to go in, your overarching concept, what you're looking for. What are the incremental cash flows? What are the cash flows that are going to change as a result of doing that project? So if you're calculating the cost of coming to do your degree on 5 islands, should you include the cost of food every day?
Yes.
Is that an incremental cost?
Yes.
Think about it a little bit. That answer too fast. Think about it. So, based on all these, I'm going to assume that if you didn't come to 5 Islands, you wouldn't eat. If you were not doing this degree, you wouldn't be eating.
Yeah, I would.
You won't be spending any money on food.
Yes. Yeah.
Right. So what is the incremental? Is it that you are not cooking and you're buying food up here, and what's the differential in cost?
Yeah. It will cost more to
So
come.
it's not just food. It's the incremental. How much extra
Okay.
that you would be spending? Cost of clothes. Is that a cost of doing the degree, an incremental cost? Okay, because I'm assuming that if you were not doing the degree, you wouldn't be walking around naked. You would still be wearing clothes. So clothes, in and of itself, clothing is not a cost of doing the degree, but it may be incremental cost. I don't know.
It's incremental for me.
Okay, so that's the idea. What are the costs that change that? So if you are doing an analysis of the financial analysis of doing the degree, what are the costs that are higher? So we're giving you some concepts to look over. Some costs, certain overhead costs, positive, negative, synergistic effects. Opportunity costs, we think are very important. Opportunity costs, anybody? Well, what do you understand opportunity costs? You're breaking my heart. As an economist, this is very heartbreaking.
You know what it is.
These terms are very near and dear to our hearts. You don't like a heartbreak, can you, girl? Don't break my heart. Opportunity costs?
The cost of working up to give something up.
Okay, to give something up. So you want to think that the tuition fee you pay, it's not just, what is it saying? It's not just the $1,800 a year you pay. What else do you want to factor in? What else could you have done with that $1,800? You could have left it on the bank. He could have earned a rate of interest. So what he could have earned on that money is a cost of doing the degree. If you resign your job to come to do the degree, then the salary that you forego is a cost of doing that degree. If because of doing at the time, I mean that's always the hardest thing to put a dollar figure on, but you're giving up a lot of time, leisure, etc. So these are opportunity costs. So in a sense, if we use the room for a computer lab, then we can't use it for something else. So there is an opportunity cost to that. So those are the kinds of things that are being factored in. Okay, working capital requirements. So quite often, because you are doing a project, there are some investments that are often required along the way, working capital requirements. So if you're gonna have a fully fledged computer lab, there might be some things you might need. You know, you need HDMI cables, you need cords, etc., etc. These are all working capital. So because you are doing this additional project, you need some additional working capital. You might have to carry more inventory in your business. You might be offering more credit as sales grow, etc. So these are all factors. Then the second bullet point is important, because it's a very common error that students make. So in arriving at the cash flows, you must ignore all financing costs. Okay, so financing costs do not go into the calculations at all in arriving at the cash flows. So interest, dividends, principal payments, money you get from a loan, money you get from selling shares, no financing costs are going into your cash flows. Anybody has a view or thoughts as to why? Finance majors, come on, finance majors. Who are the finance majors? Nobody's gonna ask you, you're finance majors? At least you admit it. Many people. Why would we ignore the financing cost? You look like you have an answer.
Very good. It's accounted for the discount rate.
Okay, so because remember somebody probably told you this a long time ago in primary school, but you forgot secondary school. You know, dividing is really the same thing as subtracting. Division and subtraction are basically the same thing. So if you take 1,000 and you divide it by 1.15 as you're doing, you're getting a smaller number. So when we do this calculation like here, what's the present value of 70,000 to be received in 1 year when your discount rate is 17%? That 17% is your financing cost. So the discount rate that you use to find an NPV is really your financing cost. So when you take 70,000 and you divide it by 1.17, you get a smaller number. So you've already taken out your financing cost. Everybody following that?
Yes.
So if in arriving at this 70,000, you took out financing costs, then you will be taking it out twice. Everybody clear on that? So when you find the present value of a number, you are in effect taking out the financing costs. So if in arriving at that number, you subtract the financing cost, then you would be double counting, taking it out twice. So don't take out any interest, no, nothing like that. Okay, so you want to note this. So this is a fairly important number, what we call free cash flow. So you want to know this formula. So you want to write it down, put it up in your room. Free cash. So the numbers that you are finding the present value of the free cash flow. This is the free cash flow in each time period. So these numbers here, this is the free cash flow from the project. So all of these numbers here, this is the free cash flow in each of those time periods. So what is it's a very simple formula. Free cash flow is equal to net operating profit. So that's EBIT, same thing as earnings before interest and taxes. So net operating income or profit, also sometimes called EBIT, earnings before interest and taxes. You subtract taxes. Then you add back depreciation, because why do you add back depreciation? It's a non-cash expense and you're trying to get to a cash number, so you add it back. You've taken it out as an expense for accounting purposes because it has tax implications. Then you subtract increase in capital expenditures. So again, you want to think about, one way to think about this is through accounting and so on. Capital expenditures, these are monies that you spend. This is cash that you spend, but it was not recognized as an expense on your profit and loss statement. If you spend $200,000 on a new van, would that show up as an expense in arriving at EBIT, that $200,000?
No.
You would depreciate it, right? But it's money you spend, so it comes out. So it's accounting for monies you spend. And also, any change in your net working capital. Okay, so that's your free cash flow number. And sometimes this number, these first two items are called NOPAT. Net operating profit after taxes, you might see that. Might not make sense to you now, but when you go to do ACCA or something, you'll thank me for it.
Okay.
You might curse now. So NOPAT, net operating profit minus taxes gives you NOPAT. Okay, and self-explanatory, you add back depreciation. And you guys know a lot of that. Do I need to go over how to do depreciation straight line? Okay, everybody here knows how to do that with the eyes closed, right? No? Annual depreciation expense using straight line method, cost of equipment, plus shipping and installation expenses, less the expected salvage value we can get at the end, all of that divided by the useful life of the equipment. This was the cost, money you spend to get it up and ready for use, minus the value at the end, divided by the life. So consider a firm that purchased equipment for $500,000 and incurred an additional $50,000 for shipping and installation. What will be the annual depreciation expense if the equipment is expected to last 10 years and have a salvage value of $25,000?
Can take a picture.
Okay, so it's the cost of equipment plus shipping and installation expense minus expected salvage value, all divided by the useful life of the equipment. $500,000 cost plus $50,000 for shipping and installation minus the expected salvage value of $25,000. All of that divided by 10. So your annual depreciation expense would be $52,500. Okay, everybody good? Okay, working capital. So again, what's the net change in your working capital? So you want to look increase in accounts receivable, plus increase in inventories minus your increase in accounts payable. So that would be the investment or the change in net working capital. Again, remember, that's that item there. In arriving at the free cash flow, you have net operating profit, net operating income, otherwise known as earnings before interest and taxes, or your EBIT. So net operating income is your earnings before interest and taxes. So it's your revenue less all of your expenses except interest and taxes. Then we have taxes, you subtract taxes, which gives you no PAT. Then you add back depreciation expense, minus any increase in capital expenditures, minus the increase in net operating working capital. So we went through how you get the depreciation. And then this is the change in net operating working capital. It's the increase in accounts receivable plus increase in inventories minus the increase in accounts payable. So you get that 78,000 in this particular case. Okay, and then how do we calculate the CapEx? So Crockett's Clothing Company is reconsidering its sewing machine investment in light of a change in its expectations regarding project revenues. The firm's management wants to know the impact of a decrease in expected revenues from $360,000 to $240,000 a year. What would be the project's operating cash flow under the revised revenue estimate? Okay, so what are we trying to do? Your free cash flow. So what do we have? We have equipment worth $2 million. Project has a 5-year life. The equipment doesn't have any salvage value. Depreciation expense is $40,000 per year. That really should be $200,000. There's an extra comma there. So $200,000 divided by 5. There's no salvage value, so it's $40,000 a year. Your operating expenses in cash are $5,000 a year. Your revenues are $240,000 per year. You don't expect the revenues to grow to remain flat, 0% growth rate. Your cost of goods sold to revenues is 60%. So for every dollar of sales, 60 cents goes out as cost of goods sold. So your cost of goods sold is 60% of revenue. Now we looked at something like that a couple of weeks ago with Bubbler and Me. You're investing $78,000 in net working capital. Your tax rate, you pay taxes at 30%, and your required rate of return is 20%. That is your discount rate. Okay, so operating cash flow. Net operating income or profit minus taxes plus depreciation expense. So since there's no change in revenues, okay, the operating cash flow will be the same every year. So what does this look like? Project revenues $240,000. How much is gonna go up in cost of goods sold? 60% of it, which is 144,000. So 60% of 240 is 144. So your gross profit then would be 96,000. Your cash operating expenses was given to you already as 5,000. That was given before. Okay, that was given as 5,000 there. Depreciation is 40,000. So your net operating income would be 51,000, or your EBIT, earnings before interest and taxes. You apply the tax rate to that of 30%, so tax of 15,300. So net operating profit after taxes, no PAT, would be 35,700, 51,000 minus 15,300. As accounting students, something should jump out at you right at this point. Let's see who is still awake. Is drinking working for you? You need a new drink. Accounting people, something should jump out at you right away. Not jumping out at you? I mean, you're half asleep. Just jumping out at you. Is that how you do accounting? After, what is, something should jump out at you? Huh? At me? Oh Lord. I'm the only witness time, you are. But think about it. After net operating income, before you take out taxes, what would you normally do? Interest, right? No interest has come out. Why? Well, remember, go back, we said you don't take out any financing costs. Remember we said that earlier? You don't take out any financing costs. So no financing costs are there. You add back depreciation and you get your operating cash flow. Really, it's like 75,700. So these are the project's cash flows. Year zero, nothing comes in. You have to spend 200,000 in year zero. That's your capex. So that's a normal flow. You have to invest 70,000 in working capital. So your free cash flow is negative 270,000. Everybody following that? No? Yes? No? Yeah, so now we get here, 75,700? No? Okay, so let's go back up to the 5. Okay, so what are the facts of the data? What's the equipment going to cost? 200,000?
200,000.
Project life, 5 years. So your depreciation expense is going to be 40,000 a year because there's no salvage value. So it's 200,000 divided by 5 is going to give you 40,000 a year. Your operating expenses, like your what other thing, are 5,000 a year, and your revenues are expected to be 240,000 each year, and it's not going to grow. Cost of goods sold, your investment in net working capital that you have to make up front is 78,000. So we're kind of running. What would these revenues, what would things look like from year 1 to 5? In each of the next 5 years, what would your revenues be projected as? you'd expect revenues of 240,000 each year for the next 5 years. Why do we say that? Anybody? The growth rate is 0, right? So revenues would be 240,000 each year for the next 5 years. Everybody's with me on that?
Yeah.
What would your cost of goods sold be for each of the next 5 years? The same 144,000 each year for the next 5 years. Because cost of goods sold is 60% of your revenues are projected to be the same each and every year. Everybody following that?
Yes.
So your gross profit would be 96,000 each year. Your cash operating expenses would be 5,000 each year. Your depreciation would also be 40,000. So what would your EBIT be each year for the next 5 years? The 51,000, 240,000 minus 144, giving you gross profit of 96, less expenses of 5, less depreciation of 40, giving you net operating income of 51,000. And that's none of those numbers are going to change for each of the next 5 years. Taxes, 30% on that, 15,000. So your net operating profit after taxes would be 35,700 each year for the next 5 years. You're going to add back depreciation